欢迎回来 Welcome back. Session of this conference. So this session we have two papers. One by Dr. Livio STRACCA, who is the Deputy Director General of International Relations at the European International and European Relations at the ECB, European Central Bank. Another paper is by Dr. Jingyi Zhang, who is the Associate Professor, Shanghai University of Finance and Economics. So let's start right now. So Livio, please start right now.
Thank you. Thank you. I hope you can hear me well.
Pretty well.
Thanks. Super. Thanks, and also thanks for the invite to this conference on China. I wished I was in Hong Kong as well. I know I've been there. I've been there Monetary Authority a couple of times. It's a great place. I hope to be there in the future. I think you can also see my screen, so I can start with the presentation. I guess in this conference, I don't need to mention that the rise of China in world markets has been spectacular, and something which perhaps a bit less known is that this has coincided also with time-wise also with the introduction of the euro in Europe, and many of the trends that we have observed also within Europe have actually been influenced by the rise of China, even though they were not visible really in real time. So I put in this chart a vertical. So this chart reports the GDP shares of Italy, my home country, and China. As you can see, when the first vertical line is when I start working, and so when I start working, Italy and China had similar size. And the second vertical line is the introduction of the euro in 1999, 1998. So as you can see, then since the creation of the euro, the relative rise of China obviously has continued to rise quite dramatically. So this change has been important, but I don't think we really capture its full extent until much later. So I think we started really discussing the role of China in Europe, in the second part of the 2000s, so around maybe 2008, 2009, but not earlier than that. So this was just a kind of in terms of motivation. But what I do in this paper, in this presentation today, is I will kind of deal with the question of whether this export boom of China has it been more a blessing or a curse for rich countries, for advanced economies. And this has a number of implications, also at the political level. Clearly the rise of China and emerging markets has had an impact on the political discourse in advanced economies, the rise of populism, for example. So this is a question which remains very important. And what I do in this paper concretely is to identify the rise of China as a latent factor, so as a factor that is unobservable. And I try to kind of unravel this unobservable factor using a combination of sign and shock restrictions, as I will explain in a moment. So, and then if you believe that I've identified this China factor, so the rise of China in world export markets correctly, I then regress a number of macro variables in individual OECD countries on this factor. And I also add interaction terms on predetermined country characteristics of advanced economies. So for example, are advanced economies that are more open to trade or more regulated, are they more or less exposed to the rise of China? So this is a really a broad brush, a medium-term look at the impact. There have been other papers using more micro data, and I will mention a couple of them in a moment, but I think it's also important to take an aggregate perspective. So we know that taking a country perspective is different from taking a regional or industry perspective, as for example, measured by Krugman. So there is value added in conducting this type of analysis, in my opinion. So what are the main results? Before I go into the details of how I reached them. So what I find is that the China factor, again, the China factor is essentially a rise in Chinese ability to export. Okay. So I find that this factor is associated with a strong world trade and the rise in commodity prices. So basically China becoming a better exporter pushes commodity price up. For individual advanced economies, it is a trade openness shock. So it leads to more trade openness. The effect of an activity in, again, advanced economies, and in particular real GDP and employment, is mildly positive on impact, but is diminishing over time, with lags, and even turns negative, with a high degree, high enough amount of lags. And perhaps the most notable finding is that the rise of China is actually mildly inflationary for headline CPI inflation, and this mainly owes to commodity prices. While I also look at other indicators of inflationary pressure, and these are more mixed. And for non-commodity import prices, as can be expected, the effect is rather negative. But overall, what I find is that unlike what is often argued, the rise of China is not consistently deflationary. It's actually perhaps even more inflationary than deflationary. But I will go through this later on in this presentation. And finally, some of the advanced economies' own country characteristics matter for cushioning or amplifying the impact of the China shock on them. But I find no individual characteristic that stands out as a key transmission channel of the China shock. So you cannot say that countries that have these precise characteristics are, in general, more or less affected by the shock. Okay, there is a number of different characteristics and not only one. Okay, so now I have a couple of slides on the literature. And first is about the transmission channels. So again, think of the rise of China as an export giant. So what happens to, and think of a world where you have only China and then advanced economies. You can think of a two world with a one rich country like the US and one developing country like China, and then China becomes more so better able to export. So what happens to the other country? So in a neoclassical theory of trade, for example, Grossman and Helpman, this is a classic win-win situation. So the developing country becomes better at exporting. The developed country can focus, in a Ricardian spirit, can focus on producing what it does best, and also benefits from cheap imports from the developing economy. This kind of win-win situation is lost when you consider models with increasing returns of scale. And one key example here is Krugman and Venables, 1995. So when you have increasing returns to scale, you have agglomeration effects. And so the rise in the exportability of a country doesn't necessarily benefit the other country if the other country loses the agglomeration benefits stemming from the fact that it had previously less competition. Okay, so so you can have a win-lose situation where the rise of the emerging economy actually is detrimental for the rich country. And then you have more nuanced models which kind of predict short-term adaptation costs, but also longer-term benefits. So one example is Dinopoulos and Segerstrom, where basically in the long term, northern firms, so northern meaning like rich countries firms, focus on high level production, so high value added production. And so in the long run, this is similar to the Grossman and Helpman world, but in the short term, there are adjustment costs. So it's not easy for firms in the rich country to completely adapt or kind of costlessly adapt to higher value added productions. And in this context, also there is a role for labor market institutions. So this is the paper by Arnold. So when it's harder for labor to migrate from one sector to another, this kind of transition process takes longer. So the short-term costs are bigger. Another element which I discuss in the paper is the possible shift to finance. So it's possible that countries, focus more on financial intermediation away from manufacturing if manufacturing faces a stronger competition from China or other emerging economies. And we know that finance is a risky activity. Can create systemic risk, but also is probably also not a high productivity growth sector. So the shift to finance can actually be detrimental for advanced economies. You have also other channels. The role of global value chains could be an amplification mechanism. Certainly, we know that the rise of China has implied more expensive commodities. So this may be a problem or additional cost for commodity importers. So if you face higher oil prices, this leads to higher cost of importing commodities. And finally, another factor to consider is that pre-existing trade links with China. So you can think of a country that is also geographically close to China. I mean, among the rich economies, think of Korea, think of Japan, may benefit more or less by their situation. So they can certainly face stronger import competition because of the geographical proximity, but also can have also more market access to China. So the net effect is unclear because you can have both positive and negative effects stemming from that. So what is also important really the literature is a series of papers by David Autor and co-authors on the impact of Chinese import competition in US local labor markets. So what they find is that Chinese import competition tends to lead to job losses in the manufacturing sector. Peterson Schott has also similar conclusions. And then you have a series of papers on the effect of either China or maybe globalization more generally on inflation in advanced economies. And most papers find a negative effect. So basically, the globalization tends to push inflation down, or if you want, deglobalization tends to push inflation up. And that discussion is, of course, very relevant today with higher inflationary pressure and discussions whether possible deglobalization will fuel inflationary pressure. And finally, there are a number of papers on more sectoral dimension on the impact of the rise of China on the reallocation within and between sectors in advanced economies, and in particular the push for labor and capital to move to higher value-added productions in advanced economies. So one other motivating factor is that basically the rise of China in export markets has also been associated or kind of is correlated with deindustrialization in advanced economies. So here the red lines is the export market share of China, and the dashed blue lines are the manufacturing share of employment. So in all these four advanced economies, you find a clear fall in the share of manufacturing employment, although the fall is more pronounced in the US and UK and is less pronounced in Japan and Germany. But overall, the trends and this kind of deindustrialization trend is common to most advanced economies. In my sample, there are only 2 or 3 countries where the share of employment actually increases over this period. Okay, so let me now turn to the more kind of econometrics methodology of this paper. So what I do is, the identification of the China factor is done using a methodology called structural factor. So it is defined in this way, in the following way. So you have a vector Z of variables, and these variables are both Chinese and global variables. I will explain in a moment what they are. So there is a vector of variable z, and from this vector you extract a few factors, orthogonal factors f. Okay, so you have a simple factor model where f is a small number of factors, and the factors themselves are potentially autocorrelated processes. The z variables are stationary and also standardized. And what do they include? So it includes basically Chinese variables. So the world market share of Chinese exports, the terms of trade, the export market share of other EME manufacturing exporters, so other than China, such as India or Mexico, real GDP in China, and the current account balance as a share of GDP in China. Okay, so these are all Chinese variables. Then I add the global variable, which is world exports in dollars. And for advanced economies, I include a number of price and activity indicators. So I include the producer price index, the core CPI, the import price excluding commodities, the hourly wage for the G7, and in terms of activity variables, real GDP, total employment, and manufacturing employment, again, in the G7. So these are G7. So you can think of this vector Z as a combination of Chinese and G7 variables, okay? So capturing what is going on in terms of the rise of China. And then what are the identification restrictions? So these are based on a combination of sign and shock restrictions. So the overall intuition is that this Chinese factor, China factor, is basically a shock, increasing China's ability to compete as an exporter. Okay, yeah. So it's easier. So if it goes up, it means that it's easier for China to export. Okay. So for those of you who are interested in the methodology, there are other papers to be looked at. So I don't really innovate much. Although I think this is the first paper that uses a combination of sign and shock restrictions in the structural VAR literature. But so what are the sign restrictions? So basically, a positive shock to Chinese ability to export is associated with higher export share of China. You have basically a contraction in either the Chinese real exchange rate or the terms of trade. I mean, I consider both in the identification, and they give similar results. So basically, you is a real depreciation or a worsening in terms of trade of China. And then I need to rule out that the rise of China is just a proxy for the rise of emerging markets more generally. And to prevent that in identification, I impose that the growth in the Chinese export share is bigger than the growth in the export share of other EMEs. So I don't want to be capturing the rise in the export share of India or Mexico and so forth. So I impose that that this factor loads more on the Chinese export share and less on the export share of other EMEs. And these are the sign restrictions. So basically, it's a competitiveness shock. So you can export more at the lower price. So that is more or less what this means. So it means that that you become a better exporter. And in terms of shock restriction, I impose that the China factor is basically positive, strongly positive in the period 2002-2008, because this is the period when previous literature has identified the boom in Chinese exports being the result of Chinese access to WTO. So Chinese accession to WTO, as we all know, is 2001. So in the 6 years after the Chinese accession, there was a boom in Chinese exports. And so this kind of narrative restriction captures this notion. And the other restriction is that we know, kind of in a narrative way, we know that in the global financial crisis, a lot of you would not expect the China factor to be dominant in the global financial crisis. And so we know that because there were large shocks especially in the economies of advanced economies. So we don't want mechanically to have a large, to associate the global financial crisis with the Chinese shock, because this was really a global shock. So I imposed that the average absolute level of the Chinese factor is not particularly large during the global financial crisis. So it can be different from zero, but it should not be large, okay? So these are the identification assumptions for the identification of this factor. This slide I skip, and so this is what turns out to be estimated. So what I find is that basically it is strongly positive in the period 2002-2008. I mean, remember that this factor is by construction equal to 0. So the average is 0, okay? So, so what I find basically is that there was a period of 2002-2008 where China really became a better exporter. And then there is another period, more or less starting from 2011, and I think this marks the beginning of the 11th five-year plan in China, where there is a rebalancing of the economy in China, less focus on competitiveness, and so the China shock turns negative on average since around 2011. Okay, so this is the period when China rebalanced the economy, and so you can see this as a kind of reversal of the China shock during that period. So what I also find is that the period in particular between 2002 and 2008 of positive China shock is associated with the depreciation on the renminbi dollar exchange rate, a rise in US dollar reserves by China, and also a strong rise in the investment ratio. So and you basically find a reversal of all these trends in the subsequent period. So the period when is a kind of counter shock, if you want, or the period of Chinese rebalancing. You see basically first a stabilization, then an appreciation of the exchange rate, a stabilization of the reserves accumulation, and also a stabilization of the very high investment ratio in China. And so how this factor loads to individual variables. Remember, I use a vector Z of variables to construct the China factor. And then I can basically compute the loading of each individual variable on the Chinese factor. So what I find is that by construction, so the variables above the line, the middle line, are the variables which I restrict in the identification. And basically what I find is that is obviously associated with positive with the Chinese export share, is negatively associated with the transfer trade, again by construction, and it also has a negative loading on the export share of other EMEs. Okay, so this clearly shows you that this is not capturing overall EMEs, is really capturing China. And then turning to the variables below the line, so these are variables that are not restricted by the identification. So you find that basically Chinese growth is positively associated, the current account position, so basically more competitiveness means higher current account, overall international trade, so basically this means that the Chinese exportability fosters international trade, and also the commodity price, so you have basically higher commodity price. And all the other variables, the price indicators are not significant, but they go in the direction you would expect. So you would expect basically headline CPI inflation to be positively impacted in the G7 because of the commodity price channel, but you also expect non-commodity import prices to go down. And in fact, I find that the correlation is negative, again, not significant. Okay, now last part of the analysis, as I'm running short of time. So I basically regress so the estimated Chinese factor on a number, well, the opposite, sorry. I regress a number of variables in advanced economies on the estimated Chinese factor. So this is the beta H coefficient, and which basically is the effect of the Chinese factor on advanced economies on variables in advanced economies. And then I add an interaction term between the Chinese factor and the vector X of variables, which are predetermined variables in advanced economies. And these are basically these are like 3 years, so as to make them exogenous with respect to the Chinese shock. Okay, and these X vectors contains a number of structural characteristics of countries. For example, the trade openness, manufacturing share of employment, the trade exposure to China, employment protection legislation, which is a measure of how regulated labor markets are, the oil trade balance, which tells you whether a country is an oil importer or exporter, and also the GDP per capita. Is all rescaled to ease the economic interpretation. This is explained in the paper, what the economic significance, how to interpret the economic significance of the results. So now I clearly don't have time to go through all the individual results, but perhaps it's best if I summarize again the results. So this summary combines both the evidence from the analysis of the loading of the factors, the one I showed you before, as well as the results of these panel regressions with interaction terms that I also just described. Okay, so these results combine both these elements. And overall, again, as I explained at the beginning of the presentation, what I find is that the China factor is associated with a strong world trade and a market rise in commodity prices. It is a globalization shock for advanced economies. The effect on activity is mildly positive on input, but turns negative over time. So over time is more a curse than a blessing for advanced economies. It's what is perhaps newer, as I said before, is that it is actually found to be mildly inflationary for headline inflation. And this reflects the commodity price channel. But for other indicators, inflationary pressure is actually either mixed or negative. And in terms of the own country characteristics, I find some significant interaction terms, but overall, I don't find an individual variable that really mediates the effects of the China shock on countries. So I could have expected, for example, the trade openness, advanced economies trade openness is a key conduit of the China shock, or closeness to China maybe. But all this, it's sometimes significant, but it doesn't come out necessarily significant all the time. So I want to spend the last 2 minutes on the inflation. Because this is a bit of a new result compared with previous literature. Previous literature has indeed emphasized the globalization on balance as a deflationary impact on advanced economies. And here you have basically two competing forces. So on the one hand, you can argue that China has been a source of cheaper manufacturing imports for advanced countries, and this leads to lower inflation, and there are papers on that. But on the other hand, pressure on commodities such as oil leads to higher prices. And this is what previous literature has called the tailwind effect. So it's really largely an empirical question whether China is inflationary or deflationary for advanced economies. And here I give you a bit of a hint of what could be happening. So these are inflation indicators for either global or G7. So you can think of this as inflationary pressure in rich economies. And the shaded area is the area of the Chinese boom, the boom in Chinese exports after China joining the WTO. And so if you believe in the story of the disinflationary effect, you would find these indicators, these levels, to be basically below the average or low, or particularly low, exactly in that period. So this you would expect if that was really an important driver of disinflation. But actually, you find if anything the opposite. So you find that the level of inflation in the G7 is, if anything, above the average, or at least at the average in that period. So that already sheds some doubts on the story of the disinflationary impact of the China shock. And another calculation that I make is in this chart. So I more or less regress. I show the same chart as before, but now I divide the countries in two groups. So those who have high or low import competition from China. Okay, so the blue lines are countries which have had high Chinese imports, and the red dashed lines are countries which had less import competition from China. So if you believe in the story of the disinflationary effect on Chinese exports, what you would find is that the countries in the blue would have had lower inflation than the countries in red especially in the shaded period. And I don't find any evidence of that. So I don't think that overall we can say that there is a lot of evidence, even from these simple charts, which are just kind of data, about the story that that Chinese import competition decisively drove down inflation. So it is mixed, but overall, I think there is no smoking gun in favor of the story of disinflation. And with that, I conclude my presentation. Again, thank you for your attention.
Thank you, Livio. Thank you very much for your presentation. It's very interesting paper. It's no surprise that you use macro data. You find the China factor actually, the result is mixed. You can almost in the past couple of years, there's all kinds of like debate. You can always for everything happened, you can blame China. You can still also praise China. So on average, the result is kind of like a mixed. I'm glad you find that result. But on this afternoon, we had a paper by Mano G. Basically, he was arguing, oh, China is a global deflator. In a way, as your last point out, there's a big debate whether inflation and it's a inflationary or it's a deflationary. I can see from your presentation you have a big point, a good point, which is the commodity price, because China's growth and the size of the Chinese economy is certainly makes the commodity price higher. But on the other hand, China also provide, in terms of supply chain, provided like, cheaper goods that might help other countries' inflation. But I want to ask you a question is, now, given that now the global situation, all these trade dispute or all these, say, for example, the U.S. take the tariff against China. What do you think, in the next few years, given the Chinese economy, if say with the maintaining of global stability, political stability, then would the effect of China will sort of gradually diminish it, and or will just become much bigger?
Okay, so here I see this in a kind of two different ways. So I think I would agree that probably the process of rebalancing and also now this dual circulation strategy, which I'm sure you discussed also in the conference, they tend to push towards I would say a less export-oriented model in China. So I would expect the China factor, as I measure it, to remain negative or to not to become positive again in the next few years. And this may also be compounded possibly by trade tensions or other factors. I mean, on the other hand, we should not forget that China is much bigger now in relative terms than it used to be 10 years ago or 20 years ago. So even kind of relatively small changes in China now have global repercussions. So I would expect a lot of spillovers from what's happening in China to the rest of the world. But I don't. I would probably see a continuation of this rebalancing process, with some ups and downs going on the next couple of years. But clearly, the political factors are also very important. But I don't think I'm well positioned to judge. I mean, probably your participants are better informed than I am on the
thank you very much. Another question is related to, you in your paper, you argue that different countries have a different impact with respect to the China factor. So from the ECB, the Eurozone economy, you see the impact is a kind of a marginal or actually serious. Say, for example, the China's export may have a bigger impact than in Europe or in some other countries. So I would like to see what your observation from the China factor on the Eurozone economy.
Okay, so here I would say two things. So one is clearly the Chinese competition had some impact on within Euro area competitiveness. So some countries lost out more than others, I would say. So what we call the peripheral countries in the Euro area face stiffer import competition from China and other emerging markets, also Turkey and others, than countries which are specialized in higher value-added production, such as Germany. So this story has been happening under our eyes for 2 decades, and I think we didn't really recognize it first. So I think it became really evident later, as I said in the presentation. It was not immediately visible. So then the link was not immediately visible, in the beginning. And in terms of U.S.-China trade tensions, we have done in DCB all kinds of simulations. I think in general, Europe does benefit a bit from trade diversion. So if there are bilateral tariffs or other trade frictions between US and China, there is in our models at least some trade diversion which favors Europe. But of course, if this becomes a full-scale trade war, then in the end, Europe loses out because among the 3 big economies in the world, Europe is the most open. So we would not, Europe would not benefit from eventually from a trade war, even though in some other simulation would benefit from some trade diversion, because basically some of the trade would shift from the US-China kind of world to Europe.
Thank you, Livio. So let's end it here. Thank you very much. I hope you can visit Hong Kong sometime. So next, let's start the next paper by Dr. ZHANG Jingyi from the Shanghai University of Finance and Economics. Dr. Zhang, please.
Yeah. So can you see the slides now?
Yes. Yes.
Okay. So thank you very much, Hongyi, for inviting me to this great conference. So the paper I'm going to present today is part of the research agenda of macro stabilization policy through the use of banking regulation. And this paper is co-authored with Zheng Liu and Mark Spiegel from the Federal Reserve Bank of San Francisco. Now, let me first go over the background of our study. So the policy in question is differential regulation on large and small banks. And this is a kind of policy that we have seen globally in many countries, either in the form of capital requirements or in the form of reserve requirements. For example, the Basel III imposes higher capital requirements on large and systematically important banks than the small banks. And we have also seen that in Brazil, the targeted reserve requirement adjustments have been applied to deal with the financial crisis. In particular, the Brazil's government reduced the reserve requirement on small banks, and they also reduced the reserve requirement on the large banks as a reward to induce these large banks to help out the small banks. And we have also seen that the differential reserve requirement adjustments have been implemented in China. However, unlike the macroprudential considerations in these above 2 examples, the PBOC's reserve requirement adjustments seem to be motivated by the desire to stabilize macroeconomic fluctuations. So this figure shows the China's required reserve ratio for various banks. And in what follows, I will just use the term RR to represent reserve requirements. And so in this figure, you can see that the red line is the China's RR on large banks, and the blue line is the China's RR on small banks. And right here, starting from 2017, a third line emerges because the PBOC began to charge a differential RR between the two as the RR on medium banks. And we also calculate the RR wedge between the large banks and the medium banks. And you can see this RR wedge as the green dashed lines. So at the very starting point of this figure is the 2008 financial crisis. And you can see that during this period, the PBOC reduced the RR on all banks, but they cut RR on media and the small banks more aggressively than on the large banks. So during this period, the RR wedge widened. And then over a relatively long and normal times, the PBOC have also adjusted the RR a lot, but they adjusted the RR with the same magnitude for all banks. So the RR wedge is constant. And then recently, the PBOC widened the RR wedge again in response to the COVID-19 pandemic. And this time, they do not adjust the RR on large banks, but implemented a targeted RR cut on the medium and small banks. So the main idea here is that the differential RR adjustments on large and small banks is not a new policy tool. However, it is not frequently used either. Instead, it is used exceptionally only in times of deep depression, for example, the 2008 financial crisis and the recent pandemic period. So under this background, our paper aims to explore the potential effectiveness of targeted RR adjustments as a policy tool for macro stabilization. And we want to address the following questions: how the economy responds to targeted RR adjustments, and given these responses, what would be the optimal policy rules? In other words, how should the central bank adjust the RRs for large and small banks over the business cycle? And then, given these optimal policy patterns, can we go back to the PBOC's practice and ask if it makes sense to adopt different policy patterns in normal times and under deep depression? And also, finally, although our paper's focus is the macro stability, we also would like to look at the implications for the financial stability and ask if there's a trade-off between the macro stability and the financial stability. So we address these questions in a dynamic stochastic general equilibrium model known as the DSG model with two types of banks, the large national banks and the small local banks. And there are four types of agents in our model: the households, the firms, and the two types of banks. And the households consumes and save deposits at these two types of banks, while the firms produce goods using the capital and the labor supplied by the households. And we also assume that the firms need to borrow either from the national banks or the local banks to finance their working capital subject to the credit constraints. So in our model, the national banks and the local banks compete with each other on both deposit market and the loan market. And I should also say that the firms in our model should be interpreted as the small local private firms in China. And this is also the type of firm that the PBOC want to stimulate with their targeted RR adjustments in the recent pandemic period. So now let me talk about the difference between these two types of banks in our model. So on one hand, the national banks enjoy lower funding costs than the local banks. You can think of these national banks in our model as the big four in China. So these national banks are larger, safer, and they have branches everywhere. So if you have deposits in these national banks, you are going to enjoy superior liquidity services. And also you are willing to accept a lower deposit rate. And on the other hand, we also assume that the local banks have superior monitoring technologies on the firm loans. In particular, if a firm claims default on its loans and the monitoring is required to liquidate the firm, then the local banks are going to do that more efficiently than the national banks. So the local banks, due to their monitoring advantages, are able to accept loans with higher default risk, and therefore they allow firms to take higher leverage. So you can imagine that in this model, the firm borrowers will be facing a trade-off between the lending rate and the firm leverage when choosing which type of bank to borrow from. And furthermore, in order to explore the financial stability implications, we also assume that both types of banks carry government-provided deposit insurance. However, in case of bankruptcies, only the local banks are liquidated at a social cost, while the national banks are recapitalized. So the cost of financial instability increases with only the bankruptcy ratio of local banks in our model. So the main idea here is that we only want to worry about the local banks when considering the financial stability issues. And finally, we assume that the government impose reserve requirement by requiring that the banks have to hold a minimum fraction of their assets as the bank reserves, and this minimum fraction is the required reservement level. So we also allow that the government impose different RRs on the national banks and the local banks, as we have seen in the data. And another important feature of our model is relationship banking. So as we have seen in the literature, there's potentially a cost of switching banks. And this is mainly because there are asymmetric information between the firm borrowers and the banks. So if a bank wants to switch to a new bank, it has to pay an additional cost in order to help the bank to better learn itself and to convince the bank that it will be able to repay the debt. And this kind of bank switching cost is also prevalent in Chinese loan market, because we can see in the data, the small opaque firms are less likely to switch banks than the large transparent firms. So we incorporate this kind of bank switching cost in our model. And as a result, the firms switch banks only under sufficiently large shocks. The idea is that when there are economic shocks, the firms may want to switch to the bank that offer better lending terms. However, the firm's existing relationship with their old banks is valuable, so that only under sufficiently large shocks, the firms will be willing to pay the switching costs and therefore switch to a new type of bank. So our model is then calibrated to fit Chinese data and solved numerically to explore how the targeted RR changes work out over the business cycle. So in what follows, I will first show the dynamics from an unexpected RR cut for each type of bank in order to explore the transmission mechanism of RR changes. And I will then compare this symmetric versus asymmetric RR feedback rules that respond to the output changes, and then evaluate these rules' performance in terms of macro stability and financial stability. And finally, I will explore the optimal RR rules over the business cycle and show how these optimal rules differ under different shock sizes. So now let me first talk about the transmission mechanism of targeted RR cut. Let's first consider an unexpected RR cut on the local banks. And we will compare the economic responses to this RR cut in two extreme cases. One case with zero switching cost, so that all the firms can freely switch between banks. And the other case with infinitely large switching costs, so that in equilibrium, the firms will not be switching banks. The comparison between these two cases will allow us to be able to better understand the role of firm bank switching behavior in the RR's transmission mechanism. And we find that cutting RR on local banks will raise the output in both cases. In particular, in the case with infinitely large switching cost, cutting RR on local banks will lower the funding cost faced by the local banks and therefore raise their credit supply, and therefore encourage the borrowing and the producing activities by the firms that are already borrowing from the local banks. So we will call this kind of effect as the intensive margin effect. And then in the case with zero switching cost, this intensive margin effect also appears, and there's an additional extensive margin effect, because in this case, some firms that previously borrowed from the national banks will switch to the local banks. And recall that these local banks, since they are more efficient in monitoring, they are going to allow firms to take higher leverage than the national banks. So the firms switch from national to local banks will expand the aggregate firm leverage and therefore boost the output. So cutting RR on local banks will unambiguously have expansionary output effects. However, this expansionary effect comes with expense of financial instability, because cutting RR on local banks will induce these banks to hold less bank reserves and therefore hold more riskier firm loans, therefore making these banks more likely to go bankrupt. So now let me talk about the case with an unexpected RR cut on national banks. And we find that the impact of cutting RR on national banks can differ depending on the switching cost. In the case of zero switching costs, we find that cutting RR on national banks will have two opposite effects on the output. At the intensive margin, it will lower the national bank's funding cost and therefore raise their credit supply and therefore encourage the borrowing and producing activities by the national bank borrowers. However, at the extensive margin, some local bank borrowers will switch to the national bank borrowers, or switch to the national banks. And recall that these national banks will require lower firm leverage than the local banks. So the switch will reduce the aggregate firm leverage and therefore cause output contractions. And in our calibration, we find that the extensive margin effect dominates, so that cutting RR on national banks will actually reduce the output. And then in the case with infinitely large switching costs, this extensive margin effect is shut off. So cutting RR on national banks will lead to output increases through the intensive margin channel. So having explored the transmission mechanism of RR changes, now let me talk about the performance of targeted RR rules over the business cycle. So in this part, we will focus on the case with a fixed positive bank switching cost. And we assume that the government will adjust the RR for each type of bank in response to the changes in the output gap. And this equation is the RR policy rule, where the parameter psi b here is the policy response coefficient for a type B bank, where B can be L for local banks or N for national banks. And the psi b measures how much the RR will increase if the GDP increased by 1%. So our policy experiment will compare three policy regions. In the baseline region, both types of RRs are constant, so that both types of policy response coefficient equal to 0. And our second region features symmetric RR rules, where both the policy response coefficient equals to 1. And in this region, the central bank will cut RR for both types of banks with the same magnitude in times of economic downturns. So this region captures the PBOC's RR adjustments in the normal times. And our third region features asymmetric R rules, where the policy response coefficient equal to 2 for local banks, but 0 for the national banks. So in this region, the central bank will cut RR on local banks aggressively in times of economic downturns, but they do not adjust the RR on national banks. So this region is consistent with the PBOC's RR practice in the recent pandemic period. And in what follows, I will show the impulse responses under these three policy regions in the presence of aggregate productivity shocks with a variety of shock sizes. So this figure shows the impulse response of the firm debt ratios and the local bank loan shares in the baseline region where the RRs are constant. And the upper panel shows the case with a relatively small negative productivity shock, while the lower panel shows the case with a relatively large negative productivity shock. And you can see that the firm's debt ratio decline in both cases. And this is because as the firms becomes less productive, the banks will reduce their credit supply in response. And it is also notable that the local banks reduce their credit supply more than the national banks. As you can see in these figures, the firms that borrow from the local banks will experience a larger decline in their debt ratio than the firms that borrow from the national banks. And this is because the local banks, due to their monetary advantages, will allow for higher loan default ratio in the long run. So these local banks' lending terms are going to worsen more than the national banks in the presence of a negative shock. However, in the case with small shocks, the presence of bank switching costs will prevent the local bank borrowers from switching to the national banks. So there's only a minor decline in the local bank's loan share. However, by comparison, in the case with large shocks, the benefit from switching to the national banks will be large enough to cover the bank switching costs, so that some of the local bank borrowers will switch to the national banks, leading to a sharp decline in the local bank loan share. And recall that the local banks will allow firms to take higher leverage, so the switch from local banks to the national banks will lower the aggregate firm leverage and therefore amplify the fall in total output. Now let's look at the impact of the RR policy changes. So here, the red dotted line shows the impulse responses under the symmetric R region, where the central bank will cut RR on both types of banks with the same magnitude in the presence of a negative productivity shock. So you can see that the firm debt ratio in both banking sector recover compared with the baseline region. So that means that the symmetric RR cut can stabilize credit supply by both banks. And then the dashed blue line shows the impulse responses in the asymmetric RR region, where the central bank aggressively cut RR on local banks, but they do not adjust the RR on national banks. And you can see that the local bank borrowers will experience a recovery in their debt ratio compared with the baseline region. However, the national bank borrowers actually worsen more compared with the baseline region. So the asymmetric R cut will benefit the local banks relative to the national banks, and therefore mitigate or even reverse the previous firm's bank switching behavior to the national banks under the large shocks. So you can see there is a sharp increase in the local bank's loan share, and you will expect a recovery in the aggregate firm leverage. And as a result, you can see here, in a case with large shocks, the asymmetric RR policy, which is shown in the blue line, can stabilize the GDP better than the symmetric RR adjustments on both types of banks, which is shown in the red lines. And by comparison, in the case with small shocks, these two RR policy adjustments are are equally effective in stabilizing the GDP compared with the baseline region. And this is because in the case with small shocks, there are no firm switching, so there's no need for asymmetric adjustments to mitigate or reverse the costly firm switching behavior. And speaking of financial stability issues, you can see here the right panel here. The bankruptcy ratio in local banks goes up in the baseline region in response to the negative productivity shock. And then the asymmetric cut on local banks will amplify this increase in the bankruptcy ratio in local banks, regardless of the shock sizes, therefore raising the financial instability concerns. So the main idea of this figure is that there will be a trade-off between the macro stability and the financial stability, and the relative strength of this trade-off will depend on the shock size, because you can see the macro stability effect of asymmetric adjustments is stronger under large shocks, but the financial stability effect is actually irrelevant to the shock sizes. And under this trade-off, we will compute the optimal policy rules that maximize the social welfare. So in this figure, the x-axis is a productivity shock size. And the upper two panel shows the optimal policy coefficient for local banks and for national banks, given the shock size. And you can see here, when the shock is really small, which stands for the normal times, the optimal on local banks is less responsive to the output changes than the national banks. This is to avoid the bankruptcies in the local banks. And then as the shock becomes larger, the local banks becomes more responsive to the GDP changes. And then when the shock is really large, which stands for the crisis time or economic depression, you can see that the optimal on local banks is much more responsive than the on national banks. And this is to help mitigate or even reverse the costly bank switching behavior following the large shocks. So you can see the GDP is quite stable in this region, but at the expense of higher bankruptcy ratio in local banks. So just to conclude, our paper examining the targeted adjustments in the DSG model with local banks and national banks. And we explore the transmission mechanism of these policy changes, and we highlight an extensive margin effect that arises from the firm borrowers switch between these two types of banks. And then we find that the targeted adjustments on local banks can better stabilize the output by mitigating or even reversing the costly bank switching behavior and large shocks. And then speaking of the policy implications, we find that the optimal policy rule on local banks can be more responsive or less responsive to the output changes than the national banks, depending on the shock sizes. And this finding is consistent with the policy patterns that we observe in the PBOC's practice. Okay, so that's all for my presentation.
Thank you, Dr. Zhang. Thank you. This is a very good paper and then very interesting. I have a couple of questions before we end this session. So the first question is, in your paper, in your setting, basically the local bank and the national bank, they have a different sort of expertise in terms of monitoring cost, and then also there is a switching cost. But just think out of the box, out of your model. If that's the case, you know, from the financial, just out of the paper or the model itself, you know, why don't just the national bank just merge or take over the local banks and then become one, you know, all the national bank? Then you don't have to have this policy. That's my first question. The second question is, in practice, the PBOC, they have a differentiated RR policy, but some of the differentiation is not differentiated against although like from the nominal terms or just they differentiate it with different banks, but mostly they differentiate against the different business. Say they target the local banks. Maybe they give more loans to those small business or to those people business in the countryside, sort of like support the local financing or for a particular sector. And then for the national banks, sometimes they support large firms or state-owned enterprise, but in the PBOC want to promote like small business because they have the large share. They hire the most people, improve the employment. So I would like to seek your comments on this.
Okay, thank you. Thank you for questions. So for the first question, so it's just what we observe for the banking industry in China, there are some banks that they have the nations. They have the certificate to be able to operate nationwide, while other banks that they only have the certificate to operate locally, and so that's what we just take given in the model. But consider if but I think even without these kind of policy restrictions, there are reasons that why these local banks will exist, because it is exactly because these banks are local banks. They specialize in providing providing loans to these local firms, and therefore they will be able to have better monitoring technologies on these local firms. If they become acquired by national banks, they will be like merged into a larger system, and maybe they will lose their advantages. But after all, I think that's our model structure is just what we observe in Chinese reality. And I think it's also the case for many other countries that different banks have different policy restrictions on what area they can operate. And then relative to the second question, is actually a very good one. So there are actually two types of targeted RR adjustments in China. One type of RR adjustments, they target on the firm loans, different businesses, as you have just talked about. So in this case, the banks, they actually have the same treatment, but the treatment is that if they invest more in certain industry, then they will be able to enjoy lower RRs. And then another kind of targeted RR adjustments is the differential RR on different types of banks, between the large national banks and the small local banks. And this is the kind of targeted RR adjustments that we want to focus in our paper. And also, I agree with you that you can also argue that even when the PBOC is adjusting, having differential RR on these different banks, their initial motivation is actually they want to stimulate certain businesses. For example, we know that these local banks, they usually grant loans to these small firms, while the large national banks, they usually grant loans to these large state-owned enterprises. So if the PBOC want to make the PBOCs reduce the on local banks, maybe their initiative is they want to support these private small business. But the thing here is that actually, we start with a model with these two types of firms and two types of banks. But we find that if it is the case, then the central bank should always adopt the differential RR adjustment, no matter if it is normal times or deep depression. So the paper our current model here focuses on why the central bank, or what can explain that the central bank will adopt different policy patterns in different economic times. Because we observe that the PBOC, they do not use these differential RR adjustments in normal times, even when they adjust these RRs a lot. But they adjust they use this differential RR adjustment in the exceptionally in the deep depression. So the focus of our paper is that we justify this with that there are switching costs when firms switch banks, and therefore we can and therefore the central bank the firms will have different lending behavior when the shock is very large or the shock is very small. So that's what we how our paper comes from, and yeah, that's my answer to your questions.
Thank you very much, Jingyi. Thank you. So you give a good answer. I think the PBOC see this presentation, they will be very happy. You give them a good reason why they do. Sometimes they do it, or sometimes they don't differentiate the RR ratio. Now, so this will be the last. Let's end this paper presentation here, and then thank all of you for joining this conference. Let's see you next year.
Thank you. Thank you.
Thank you.